Oh,
That
you're gonna
already
have to
came on.
open up. Oh, we're going live now. Hold on. We're live. Hi, guys. Good morning. It is May 5th, 2021. It's Minnie here from Brampton, Ontario. And I'm really excited to bring to you someone from the mortgage industry. We have Danny Nasseir, who has been in the mortgage industry for quite some time. And Danny is joining me today. We're going to go over some of the things that the industry is offering, a little bit about himself, and what kind of services he provides for clients, whether you're a first-time home buyer, an upsizer, downsizer, investors. Um, Questions are welcome. So be sure to drop any question that you have in the comment section below. Don't be shy. If you are looking for a mortgage, we can obviously talk to you on the side. So I'll hand it over to you, Danny. Tell them about yourself and go ahead.
Yes, good morning, Minnie. Thank you for having me, first of all. My first connection with you in terms of a live broadcast. We've spoken in the past. I've been in the industry for over a decade and change. On the um, I guess if you want to put it semi part-time, full-time, what kind of thing, because I also teach at Sheridan College, which I've been doing for about 22 years now. I offer residential services mostly. I'm with Northwood Mortgages, which is a pretty popular large broker house. And the long and short of it, we can offer pretty much anything within there, including commercial, even though I don't really jump into the commercial side of it, but I can definitely lead your hand and take you in that direction. But primarily in the residential sector for me.
Mm-hmm. So, I mean, thank you for sharing that. I mean, that's quite a history there in such a short introduction. So,
Uh,
Danny, let's touch on background. So, when dealing with real estate, we're dealing with families. We're dealing with families under a roof, and I think, quite often, you in our industry it gets overlooked or it gets to be transactional based. And one of the things that's very close to my heart is understanding that our business is customer service. It's a lot of emotions when people are buying and selling a home. And it's so important. One moment, life of an entrepreneur. I can't miss this call. One moment. Hey, Mark, can I call you back? I'm just in a meeting right now. Sure. Yes, I did. It's check WhatsApp. Okay, thank you. Bye. All right. So sorry about that. So yeah, so quite often, in our industry, a lot of the times it gets missed, and the importance of the family under that you're doing the transaction for gets overlooked, right? So it should be quite heavily customer based, and a lot of the time, 50% is very emotionally driven by the client. With Danny mentioning, he's been teaching at Sheridan College for 20 years, you say?
just over, probably going into 22 this year, I think.
22 years. So over 2 decades. So that's a lot of experience, a lot of time dealing with people for 22 years. What do you teach at Sheridan College?
I'm IT, so I teach in the Faculty of Business. So I teach basically computers from a business perspective. So how do you use computers in a business? One of the reasons, if I may jump ahead, Minnie, that I mentioned that as well is I've kind of in a place where it's really hard for me to take off one of my hats when I'm doing my mortgage business. I just wear multiple hats and I integrate them in whatever I do. And what I'm trying to say is when I speak to clients and we're talking mortgage, I just don't go, well, okay, here's what I can give you, here's a rate, here's a structure of a mortgage, something like that. I put on or keep on my teaching hat, and I like to let them, because a lot of time people really don't understand the entire process. So I like to go from cradle to grave, basically, when you're talking about mortgages. Why am I doing, what am I doing, why am I recommending, what am I recommending, and why are we going in this direction as opposed to another direction that your coworker may have said would be the better direction. So I think the education aspect of it, when you're dealing with your clients, it's really important for them to understand what the process is and what they're getting into.
Yes, and thank you for sharing that. So, just to highlight, it's Danny's coming from bringing his for his teaching experience, sort of educating you in the process as a client when you're dealing with that transaction. If I'm hearing correctly, you're educating them about their choices, their options, and why you're doing and giving these type of recommendations and options to them so they can make an educated decision. So you're kind of bringing that experience and that hat on from the teaching perspective into your mortgage business. So did I sum that up right?
Absolutely,
Yeah,
absolutely.
good, good. So Danny, I mean, how long have you been in the mortgage industry? Number of years, and how long have you been with Northwood Mortgage?
Just over a decade in the industry, and Northwood, I would want to say maybe 6, 7 years or something like that. We were a smaller brokerage in the Brampton industry, myself and my broker and a few other agents. And a long story short, there was a merger between our brokerage, and we kind of merged into the Northwood family. Which is great for us because being one of the larger and more reputable broker houses in the GTA area here that I work in, we're able to access products that, as a smaller broker house, you can't get, and that means that, our list of lenders, used to be this, now it's this. You can't even see, right?
Yeah.
So, it allows us, that opportunity to access more lenders. It gives us that opportunity to be able to get better promotion from those lenders, and the list just goes on. Long and short is, it's the better thing to do. It makes me put myself in a better position to do better for my clients and your clients.
Surf services. So one of the main questions that I'd like to get answered today, for especially for first time home buyers and even for upsizers or doing your second transaction, um,
Mhm.
there's a major difference between a mortgage manager at a bank or in-house mortgage person, let's say for one of the top five banks, and there's a difference with a mortgage person there and a mortgage. Your title is
Agent,
agent,
mortgage agent.
right?
Right?
Mortgage agent working in a brokerage or in a broker environment. So let's educate. Let's share what that is. I know some of you may already know the answer to this, but this is tailored for people who are not really sure. So you might walk into a bank and you might go to TD and get a pre-qualification or a qualification, which we'll get into the difference a little bit later. But there is a major difference between going to a broker and also shopping at your top five, your banks. So why don't you tell us about that?
Where do we start? That's a loaded question. You can go on and on for hours on that, but let's see if I can summarize it as quickly as possible. First of all, in our industry, in the broker section, not big bank section, in the broker section, there is licensing, right? I know you've got a background, you're well educated, and I know you've dabbled in so many different aspects of getting yourself educated in this industry. And I know from past experience, you've done some of the mortgage courses as well. So you understand what I'm talking about. So we have to do this. And without this, you can't practice. On top of that, getting through the education part of it, doing all your exams, getting it, all of that, that is one aspect of it. But you now have to marry that with the brokerage. If you don't take that education and then get a brokerage to hire you, then you don't get a license number from the government, and you're not allowed to practice in terms of that. Banks, on the other hand, they have their own regulations. So you just, finish your university, whatever the case might be. You got a degree in economics or something. You get a career in the bank. You can be dropped into the mortgage center of the bank. and start working there. But your economics degree does not necessarily relate directly to mortgages and mortgage rules, and how all the system works together. So you're not called a mortgage agent or a mortgage broker. You are called a mortgage specialist within the bank. Now, granted, over time, experience, mentoring, whatever the case might be, you will eventually get to where we're at in the broker channel and do that. But sometimes high turnover in banks and all this kind of stuff, it's a hit and miss. For me, when you walk in the door, you can get somebody who has really good experience and they can really help you out. You can get somebody who is full blown rookie, who will just give you the usual thing. Yeah, 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 don't worry about it. We can help you out. Yeah, just give us this, that. And you're thinking, I've got that big sign outside, right? So I've got a reputable bank that's been around for a million years. So, I'll be fine, right? But you really don't know that, right?
Yeah, and I think one of the things I'd like to highlight, yes, I did my mortgage licensing and all of that, but I'm a firm believer that you can only really be the doctor of one thing and a specialist of one thing. So I did that for education for myself and for my clients.
Exactly.
Yeah,
Exactly. So understand the entire industry, not necessarily practicing it, but you know what is around you.
and I can
You
communicate
can't go wrong with
effectively.
education, right?
Yeah, and I can communicate. And this was, I know I've done this like years ago, over I don't know 9 years or so ago or more. And we have to renew, and so every 2 years. So that aside, I think one of the things you highlighted there, there is mortgage agent and mortgage specialist, and that's a title that you're given at the, let's say, at the banks and as a mortgage specialist. And really, from my understanding, is that a mortgage broker, the main difference for a customer is that mortgage broker, Danny mentioned that you've got like a list of lenders, and one of the banks is probably going to be on that list, or many of the banks are going to be on that list. And so when you're wearing the cap as a mortgage specialist in a bank, you're really selling the products that the bank, or the lending products, or the mortgage products that that particular bank that you're working for is offering. But when you're wearing the sale mortgage agent cap, you are able to offer different products from different banks and different lenders, right? So you're able to service that
Absolutely.
clientele differently, right? So you can
Absolutely.
elaborate on that. So if I'm going to TD, I'm only really able to
Mhm.
talk to that the mortgage specialist is only able to talk to me regarding the TD product. And they're also
Absolutely.
limited. If you're walking into one of the branches, let's say, disclaimer, I'm not using TD in any way as a part of this, but I'm just using as an example of one of the banks. And let's say we're going to one of the banks, we may or may not have someone there who has the experience, right? Or who has done enough of the sell enough of that product to be able to service us really well. But when you're coming from the broker side, then that's if you're walking in. Like for myself, I have mortgage managers that works at a different bank, and I know they've got the experience under the belt before I refer my client. But when you're coming from the broker side, tell us about that. Tell us about the advantages that, let's say I were to come to you for a mortgage. What are some of the advantages of coming to you for a mortgage?
Well, you've hit a few nails directly in the middle there. Product, you can be at a bank for multiple years and have great relationships with everybody in there, and you walk in to do a mortgage transaction, and all the people, fantastic people, you've been dealing with them forever, assures you that they will take care of you 100%, give you the best service, the best product, everything, and that may be so true. However, as you pointed out, they will give you the best product for that institution. I have access to the best products for 147 lenders, 147 lenders. Now you can shop around, and people do that. They'll go to one big bank, they do a shop around, they go to the other one, they go to the other one. What they don't realize is that there's a very, very big probability that each one of those big guys are pulling your credit. So that's a bad thing, because all of a sudden spoke to maybe five big banks in in 2 weeks or something like that, and all of a sudden the credit bureau brands you as a credit seeker because it looks like you're going to one place, you didn't get the money, you went to another place, you didn't get money. The system, it's a computer system. They don't understand that you're getting, basically shopping around looking for a good rate, looking for a good product or something like that, right? So in essence, from the other side of it, mortgage agent, mortgage specialist, education is one. Knowing how to underwrite a product is a big, big, big deal because, like, for instance, I'll give you an example. I just closed a deal on Friday where one of the big guys were having problems getting a refinance done for a client. And eventually I took it over because they couldn't qualify for it. What they didn't realize is that, when you're underwriting, there's certain things you can do. Now, whether that institution could do or not, I don't know. But bottom line is, I was able to use Canada Child Tax Benefit as income with one of my lenders and be able to bump up their entire income and do that. So when you look at mortgage agents and you look at mortgage specialists out there, you're looking at two different persons. A mortgage specialist could, and honestly, I've never really tried to look for people in banks to do mortgages because I do it myself. And I've got people within my industry, but I've never met any of the few that I've met that actually have done mortgage education, done the mortgage courses, done the education to understand how everything works, to understand what is a GDS, what is a TDS, right? Understand debt service and understanding how to construct a deal, how to do it properly. I'm talking front end, your first contact within there. I'm not talking mortgage center back end, which we don't see as a consumer. That's a whole different story, right? You've got experience underwriters and all this kind of stuff that are doing it. But the first contact when you walk in a branch, that person that assures you that everything is going to be okay, that's your mortgage specialist, right? So you're going to be mindful of that. Now, having said that, there's mortgage specialists for big banks that are mobile like myself. So they go around meeting people just like myself. So I'm sure that due diligence was done somewhere along the line, and those people are well qualified to do that job, right? So at the end of it, long and short, we're all got our roles to play. It's the comfort zone. It's you having that trust in the person that you're dealing with, having the confidence that that person knows what they're doing, will be able to structure that deal properly if you will be able to get you into that place where you want to go. And if I can read that thing behind you, it says make your dreams happen, then you have to have that confidence to allow me to make your dream happen together with me.
Okay, thank you for that, Danny. So
Mhm.
we've clarified really some of the differences between a
Mhm.
mortgage specialist and a mortgage broker, and a
Mhm.
little bit of your why, which is you've got the education. Mortgage agents are licensed and they have to do training to get their license and education. So one major difference, and I guess in the field, major difference is that with that education and that licensing and that regulatory, that body that comes with your licensing, we've got different mortgage agents have a list of lenders which offers many different products as opposed to one lender with a
Mhm.
with a, with a with a set products that a mortgage specialist may be working for. Let's talk some rates, Danny. So now
Let's.
we're talking about, let's get into action. I mean, so okay,
Yeah.
we've decided. Oh, one thing I wanted to touch on is what you mentioned. Actually, it's about credit scores and just to highlight. So if you were doing this solo and you're going to bank A and bank B and bank C, and you're kind of pulling, all of them are pulling your credit. The system understands that you're shopping around there, or you're trying to get mortgages, or you're trying to borrow some uh, debt or credit. They don't necessarily know that you're shopping around trying to make a decision. While if you're going to a mortgage agent and you've got this one person pulling your credit, knowing what it is, and then analyzing to see what lender you will best fit, depending on what you're trying to accomplish in terms of your mortgage, right? So wanted to highlight that, which is what you've said. So just to kind of summarize that. Let's talk rates. So you're with Northwood Mortgages, a smaller brokerage, but has a really good list of lenders, which is what you've called out in the beginning, right?
Mhm.
And so Rates. What are some of the rates? So right now we know how competitive are you with the rates. Everyone wants to know about rates, and we know it's not only rates, it's a combination of things that helps to build your mortgage. But that aside, what are some of the rates we're seeing that you're seeing from the different lenders out there that you can potentially get from your client? And this is not setting stone, guys. This is what, there's some files that you may be able to get a really good low rate and some files not. So we want to know what's your top good rate that you're seeing right now happening in the industry.
First of all, I like the word you said, competitive, and I sometimes be competitive. So I want to say we're not a small brokerage, we're a big brokerage.
Oh, big brokerage. Okay, good. Thank you for clarifying that.
We're a big brokerage. We're not a small brokerage, right?
Oh, maybe the
Um,
office in Brampton is small. Is that what it is?
yeah, we're just like a satellite. It's basically
Oh,
your personal office kind of thing, right? But
okay,
we've
got
got
it.
a huge big office in
Big
Markham,
brokerage.
right?
It's just a
Yeah, big
small
brokerage in
centralized
Markham,
office. Okay.
huge, right?
Thank you, guys. Thank you for clarifying.
And I mean, 147 lenders is not small potatoes here, right?
Okay,
You
good.
know, now when you talk rates, because we're big, and which is why I wanted to point that out. Lenders on a regular basis, I get emails coming in all the time. They're giving us promotions. So rates are changing, on a regular basis. So we've got special promotions for first time buyers. You got special promotions for a conventional deal. There's so many things that comes along the pipe. um, a mortgage for a consumer is a mortgage, but a mortgage is not a mortgage for us, right? You mentioned something like, what, once, we've done our due diligence and whatever, credit and etc., we know where to place that client with which lender. Okay. And that's the reason for having so much lenders. It's not we're competing one against the other, but different lenders have different niche markets, right? So it depends on what you're doing. If you're just doing plain residential, I mean, in the past few months, the fixed rate has been inching up a little bit. So people are not so much fixated on going for a fixed rate. They're more hanging around the variable rates, and variable rates are fluctuating depending on which lender you're doing. And I've seen rates from uh, 99 basis points up. A lot of deals I did earlier in this year was around the 1.5% mark rate. But there's rates coming from 99 basis points going up. That's basically 1% coming up. For me, that's
So
free.
it's being from 0.99%.
I've seen from 0.99. I've seen 0.99 advertised going up. So and when you look at where the rates are going at, and how you choose what you're doing. There's the two main differences with the fixed rate and the variable rate, right? The variable rate, as the name suggests, it varies. Why does it vary? It depends on the Bank of Canada. So if Bank of Canada overnight goes up, then your rate goes up. If it goes down, your rate goes down. So in essence, what you're seeing is the fluctuation in terms of what each lender offers. So a lender in today's environment, a long time ago, you would have prime plus something. So the prime is the benchmark that Bank of Canada sets. So you got a prime plus something in the old days. Now it's not so much that, it's the other way around. It's prime minus something. So if you've got, for instance, today prime at most banks are 2.45. So if you've got a prime minus 1.10, then you've got a 1.35%, right? And that's a variable rate. Now that can be there for quite a while. We're in a pandemic, as everybody knows, and as a result, the economy took a bit of a hit. And when you look at it from an economical perspective, and you look at the economics of Canada, logic tells you that what, if we've lost so many jobs, this is happening, that is happening, for the central bank to start pushing rates up in a hurry, I would bet slightly against that. So a variable rate is a good place to go. Fixed rates, you got to look at bond yields and all this kind of stuff, right? That's a whole long story to get into to understand how rates are set. But fixed rates are definitely over the 2% mark now. At most lenders, you might scrape in, 2 or slightly under for fixed rates, but most of the time that you're seeing recently now for fixed rates, they're definitely going up over the 2% mark. Some of them pushing up to 2.5% on fixed rates. So variable rate is still a good place to go. One thing I just want to touch on quickly that you mentioned, that rate is not the only thing that you have to consider when you're thinking about a mortgage. And I really like that comment, because that is something that I try to put to people, because again, I did another deal not too long ago where client was trying to get out of a mortgage to get into a better place and do a refinance, and ended up with $19,000 in penalties. So that's because they were on a fixed rate and run for a certain period, and you got to do the IRD, which is the interest rate differential, for the big banks to calculate this and all this kind of stuff. So you got to look at prepayment privileges. You got to look at penalties if you want to break the mortgages. There's a multiple things that you got to look at in addition to rate. Rate is important, but it's not necessarily the number one. You got to take factor. What is for me, my goal when I'm speaking to a client is what is your like your short term, your medium term, your long term goals. What are you hoping to achieve? If you look, I'm going to buy a house now. I'm going to settle in this for the next 5 years. I'm not doing anything in house. I've got other things that I'm going to do. Then you know what? It might not be a bad idea if I get a good fixed rate to lock you in for 5 years. But if you're saying, you know what, in 3 years, if prices keep going up and I can flip out and move up or something like that, because I'm starting up, I'm in a townhouse. If in 3 years prices go up, I can flip out, buy a detached somewhere else, then I will. Then I'm not sure if a 5-year fixed rate is the best thing for you. Maybe a 3-year fixed or a variable, right?
Yeah.
So and when you look at a 1 year, 3-year, 5-year, it's all different rates, right?
Yeah.
So
So,
a loaded question.
yeah, so it is. So I'm kind of like breaking them out into pieces. So we're looking at rates where Danny's seeing rates anywhere from 0.99, so just around a percentage and up. So those rates are available out there. Obviously, we've got to do pre-qualification and see if you meet the requirements to get those rates. But we're seeing rates. Danny's seeing rates from 0.99%, so 1% and up. And depending, so when we talked a little bit about, rates is not the only thing, and I would kind of like to elaborate a little bit more than that and another question. But before that, someone's saying that they're not hearing. Hold on. Okay, I'm hearing sound. Navin, are you hearing now? So check in your end. It seems the sound is working fine, but thank you for letting me know. I'm testing it as well on my phone, so it seems to be working okay. If anyone else is not hearing me, let me know. Paul is on. Hi, Paul. Thanks for joining. Amrita, thanks for joining. Just let me know a thumbs up if you're able to hear both myself and Danny. I've tested it, and it seems to be working fine. So let's talk about, I can hear you guys. Perfect. Thanks, Paul. Appreciate it. So give me 1 second. Custom in meeting. Sorry, guys. This is how this goes. So now we're talking about variable versus fixed rate. And Danny did touch a little bit on variable versus fixed rate. And before a variable rate, but what is a main difference? So we know you kind of have to know what your goal is. And I'm looking at the question, but you kind of have to know, and I'm going to put this question up on the screen. Let me just do it quickly. So variable rate versus fixed rate. When you are going to look at purchasing a home and you're doing your mortgage consultation, and this is a free consultation, so you can reach out to Danny directly or reach out to myself. We can put a date and time together where you can have a meeting with Danny, and he can do that consultation to see what recommendations and options he can provide to you. But during that consultation, the consultation is also to know you. Remember I talked about in the beginning, a lot of the time in our industry, clients are treated as very transactional based, and we know that in our industry, it should be more customer service centric and 50% emotions from the clients. And And to understand and to be able to serve with that, we need to understand the family that's purchasing the home, what the family goal is over the next year, 2 year, 3 years, 5 years, how young are the kids. Sometimes family does not everyone kind of, for me, I over organize and my desk might be chaotic, but I still over organize. So I might know what my today's goal is and next week goal is and next year goal is. But a lot of the times, even clients purchasing a home, they don't necessarily think realistically, what am I going to be doing in 3 years in regards to my home, especially a first time home buyer. 75% of people living in the GTA are immigrants. Myself and Danny, we immigrated here to Canada and we're in the GTA. I'm in Brampton, he is as well. But a lot of the times for first time home buyer, we're coming with that notion and concept from back home, wherever back home is for you, thinking that we're going to buy a home and we're going to be here for a while and we're going to raise the kids. And we get excited, especially for younger couples. But we know in Ontario, a family moves 3, 4, 5 times. And so depending on the age of the children or the goal of the couple, that goal need to be established in that consultation. That's where we're able to direct you on what neighborhood might be better for you if it's real estate related, or and depending on schools, or that's where Danny will be able to say, well, listen, Minnie, based on your profile, young family, 2 children, these are the ages. There is a possibility that you may be moving, although you don't see it yet. And I know you want to live here for 5 years. But based on their risk analysis, you may recommend an option of a fixed rate, a 3-year fix, or a variable rate. So this will all happen in the consultation. So even if you haven't really figured out what your goal is on a clear path, we'll still have some recommendation and options available for you to go back home and think about. So variable rate versus fixed, one of the main difference is, tell them that.
Well, as the name suggests, it's right there in the name. A
Yeah.
fixed rate, it's written in stone, right? It's fixed over whatever period you choose, 1, 3, 5 year, whatever period you choose, the rate is fixed. So if you look on the, you put on the news and you see rates are going up through the roof, you ain't gotta worry. You're right there. If you see rates are dropping, well, you might want to worry because you're still right there.
Yeah.
Rates are dropping around you, but you are fixed for your term. You can break your term, but then there's penalties and all of that involved. A variable rate, it's variable based on Central Bank of Canada overnight lending rates. They set a certain benchmark. Right now, the benchmark is 2.45, and based on the 2.45, the lenders use that as their starting point and say, here, I'll give you, they call that the prime rate. So I'll give you prime minus 1%, just a straight wrong number. So if I give you prime minus 1% and you're at 2.45, at prime, then you're getting an interest rate of 1.35. Central bank says, you know what, economy is not doing good. Their overnight uh, is 0.25 that they use at. They're different layers, right? So they're at they're 0.25, which is 25 basis points, and then it comes down to the bank level where they add on something to that to get to where they're at. Usually it's 2%, but in the last 5 years, that kind of got a little messed up and it's a little bit more than 2% now. So when you look at that, the way that is set up, if the central bank says, look, I'm going to drop this thing by 0.25%, I'm going to go with a 0%, then 99% of the times, or maybe a little bit less, the banks will follow suit and drop their prime by that 0.25% as well. So all of a sudden, they're no longer 2.45, right? They're now 2.2. So you're still prime minus 1%. So now your rate is 1.2, right?
1.2.
So, but there's the flip side of the coin that happened about 4 years ago or so, where central bank was looking at inflation and all that kind of stuff, and then they upped their overnight lending, I think 3 to 4 times in a very short period of time. So all of a sudden, you went from a low prime to a higher prime. So if you went up 0.75%, then your rate that was 1.5% can go to 2.25%. One of the things that I do want to point out that you mentioned first time home buyers is that I find first time home buyers are kind of the ones that are, because they're getting into this for the first time, the largest purchase of their life most of the time. So big debt for them. They're kind of very skeptical on the variable rate because they're nervous. They're extremely nervous that this rate can go up. And the problem is we talk to people, right? And that's not a bad thing. But everybody out there is an expert. Unfortunately, not everybody that thinks they're an expert is an expert. And you've got so much little fears and butterflies in your system that it's hard for you to decide, do I really want to take a variable? Do I really want to take a fixed rate? And the first time home buyers are a little bit struggling on the variable because they go, you know what, I don't want to wake up tomorrow morning and then all of a sudden my payments go from 1,500 to 1,750. I'm going to get a heart attack. um, Seasoned buyers who have flipped one, two, three times are comfortable with the variable rate, in my opinion. Now, this is not written in stone. You've got younger people who are, good with their economics and everything and are willing to take that risk as well. So, how do you choose if you want to do a variable or a fixed rate? It's all that gut feeling. And one of the things that I come across a lot is I want to sleep at night. I want to make sure for the next 3 to 5 years, again, especially first time home buyers, this is not going to change in me. I'm going to be fine. That's what most people use to make their decision. Do you agree with it or not? That's not for me to judge. That's their choice to make. You give them the facts and they make an informed decision based on that. When you're in a fixed rate, you can't change it. You're stuck. You're written in stone. Now, you could go back to your institution and say, hey, rates have changed a little bit. What can I do? A lot of the lenders will do a blend for you. They will say, listen, I can drop your rate. Maybe you're paying 2.99. Rates have come down a bit. I can probably give you 2.6, but you got 3 years left on your amortization. We will bump it up to 4.5 years because they're trying to make their money back. So all of a sudden you got 3 months left on the 3 years left on the mortgage. Sorry, they bump it up to 4.5 years left on the mortgage. Drop your rate from 2.99 to 2.6, and you're now paying a low rate. That's the only time you can really change a fixed rate. Variable rate, on the other hand, you can lock in at any time with most of the lenders. You just go, hey, what is the fixed rate? Now, be careful. A lot of people make the mistake because when we're having the upfront conversation, we go, today variable is 1.5. I'm just throwing numbers. And fixed is 1.9. And you go, you know what? I'll take the 1.5 for now. Then in 6 months, they see rates are going up or central bank changed the rates or something like that. And all of a sudden they go up and they go, you know what? I'll take that 1.9 now. No, it doesn't work like that, right?
Yeah.
The fixed rate that you're going to lock into is the fixed rate of today,
Yeah.
not the
So,
fixed rate that you could have gotten when you did the mortgage. So
yeah.
whatever the fixed today, you can always lock your variable in to that fixed rate that is offered by that institution today.
Yeah. So thank you for that. So just summary, what it is, yes, you can, if you're not sure whether to take a variable or fixed rate at the time of your mortgage, if you're taking a fix, you kind of have to be sure that you're taking a fix, because changing that after the fact, it's challenging. You could go back to your lender, yes, but it's going to be tougher because fixed rate always carry a penalty. And the reason for that is because, think of it this way. Think of it as you are a lender. So you've got $1 million, just as a number, you can be a potential lender. So you're lending money, just like how the banks would. And so you're lending someone your money at an agreed upon rate. Let's say that rate for, easy explanation is 5%. So now I know as a lender, or as a lender, that you're getting a 5% return on that investment. So if you want to come in back and say, well, listen, rates have fluctuated a little bit, you as a lender would be like, this is a great customer. She's been paying her mortgage. She's doing well. Well, guess what I can do for you, Minnie? Yes, I'm okay. We can do a little bit on the rate side, but I want your commitment for additional year. So that's kind of one way of doing it. And there are many other creative ways of doing it. So fixed, you have to know your game on. You kind of have to be very decisive on your decision when you're making a fixed rate, when you're taking a fixed rate. Variable, on the other hand, you can take a variable and yes, you can change that variable to a fixed. However, do keep in mind that while you're taking your variable and your example at a 1.5% interest rate, and 6 months from now, you're seeing it go up in a quarter, right? Obviously, the fixed rate is going to go up as well. And this is where your risk, what do you say? The level of risk that you would like to take, right? Depending on in your
Yeah, your risk tolerance,
personality, your
basically.
risk tolerance. Thank you. That you will kind of then do that. The other thing that I want to clarify with you, because you're the expert in that area. Now, I am taking a variable rate, and my mortgage is $2,000 a month, monthly payment. Okay. Now, if the variable rate goes up, does my mortgage payment monthly always go up?
Not always, most of the time. Depends on the original contract. You get so many pages when you're doing a mortgage commitment and you're signing up with a lawyer. Problem is, as consumers, not that we don't want to do our due diligence, but the problem is there's so much fine print to read that nobody reads it. But there's some mortgages where you can stay on the same payment with a variable, right? There's some lenders that would offer that, and you can stay on the same payment. But what happens is the amount that you pay usually is divided in two pieces, right? There's one piece that goes towards paying down the principal, and the other piece that goes towards interest, right? That's the profit that the lender makes, right? They're running a business, obviously. But they're also the more traditional variable that if the rate changes, then the payment changes, right?
Okay.
So the payment can go high. So you can have it where the payment still
Fixed
stays the
monthly payment.
same,
Yeah.
but the portion, let's say, a nice round number, you're paying $1,000 a month, 400 was going, towards interest, 600 was going towards principal. Rate changes, all of a sudden it's 500 to principal, 500 to interest. It
Yeah.
can be like that as well.
So, guys, you want to make sure that you're interviewing a mortgage agent who's got knowledge and experience to understand what kind of proposal or options or recommendations to give to you, because depending on your risk tolerance, you may want to make sure that you have a fixed monthly payment on a variable rate, because you want to make sure that your income that your family is bringing in can keep the roof over your head, depending on your risk tolerance. And then there are cases where, if the rate goes up, then that monthly payment also go up, right? So you want to
Yes.
make sure that the mortgage agent that you're dealing with understand and have the experience to be able to make these types of recommendations to you. So that pretty much, I think, is good information regarding fixed and variable mortgage, right? Because a lot of the times clients hear about it and we may think that they understand, but they don't necessarily understand. Because my clients usually come back to me saying, Minnie, well, what should I do? And then I said, well, let's see. This is what's going to happen. This is what they're saying here. Maybe do fixed monthly payments, right? And then you can keep it and top up on your prepayment privileges later on, right? At that time. So we touched on, mortgage is not just about the rates, and it's very, very, very important, because sometimes clients shop around and they're like, wait a minute, my friend got a rate of 2%. Why can I not get a rate of 2%? And from my little understanding is that every lender is different. So remember I gave you that scenario where you got $1 million and you could be a lender? Well, you can write your own rules and who you want to lend that money to. And it goes for every lender. So every lender has got a bucket full of cash, and then they can decide, well, I'm going to lend 25% to the nursing industry, and you're going to see those files pass through, and then I want to lend this to the automotive people, or on the underwriting rules and ratios and all of that. But for the most part, you as a lender has your own kind of rules and what type of people or career, or you're going to lend a bucket out from that bucket of money, right? So now we want to talk about why although you and your friend are earning almost similar income, but you might be in a different industry, why is it that you can't get the same rate, or the same rates may not be available to you? Because every mortgage is written for that particular family, age, credit, all of that is taken into consideration. So I'd ask you, Danny, to say, because this is always, well, my cousin got this rate, my aunt got this rate, my uncle got this rate, and it's not only about rate, it's about your goal. What are you doing the next 3 years? Where your family's at right now, what type of job you have in the industry, all of these things have an impact on your rate, correct?
Absolutely, absolutely, 100% correct. When you look at what you're negotiating, first of all, you took look at it at a high level before you get down to a granular level. At a higher level, you're looking at which lender you're dealing with, what they're offering. Okay, again, being one of the bigger broker house in GTA, we sometimes, not all the time, but I would like to think a lot of the times we have the edge where we have promotions coming from lenders, right? So they say, hey, we got a special promotion for Northwood for this week. We're giving, this is what we're usually giving. We're giving 10 basis points off of that or something like that. So that allows us to give, a better rate. So you might say, listen, I'm dealing with a specific big bank, not necessarily directly through a brokerage like us. And, my broker got me this, and, your own is 10 basis points higher. Why? Right? Well, maybe that brokerage was us. We got a promotion from that same lender, and we were able to offer that to our client, right? There's also situations where we're able to negotiate rates as well. Whatever's written there for us, sometimes we're in a position where we can negotiate. Some of them, not everybody, offers you sometimes a buy down. So I can invest, part of my salary in a buy down. That allows me to get a better rate for my clients as well. So that works as well. And then coming back to, getting into a little bit more granular into all the things that you mentioned, credit takes, a big part of that process in terms of what you get. And if you actually are approved to borrow that, then you've got your income, where do I work? What industry am I in? And all this kind of stuff. So those are things that are all factors in it. I mean, today, if you're a healthcare worker and you go and say that, listen, my client is a nurse or a doctor or something like that, lender has no problem that you're going to lose your job because, man, you're in high demand today, right? However, if you're doing something totally different, if you're manufacturing clothing and you're working in a clothing warehouse or something like that, then they're gonna go, I don't know. I mean, clothing is not essential right now. So, what are the possibilities you're going to be laid off next week or not, right? And the reason I'm going down this pandemic road is that I saw, from sometime in just around summer, before summer of last year, where a lot of lenders are making sure that they're getting documents really, really, really up to date, like pay stubs. Like I've gotten pay stubs in there already, but the deal has been going on for 6 weeks, and they asked me for an updated pay stub, right? So they want to make sure that you were working 6 weeks ago, but I mean, with this pandemic and all of that, were you still working last week? And the reason they're asking this is not because they don't want to lend you the money; they want to. That's how they do their business. If they don't lend you money, then they don't have a business. So they want to lend you. So don't feel the lender doesn't want to deal with you. It's just that they want to make sure that their investment is protected and you're in a good place to, make those repayments when the time come along. So you got to look at your job. You got to look at your credit. You got to look at where the property is located and all of that. When I started this in this industry over a decade ago, we were having problems doing a mortgage in Innisfil. Would you believe that? Innisfil is so popular now, but there were so many big lenders that didn't want to lend in Innisfil, right? Which is just outside of Barry there. So I mean, they have their choices and they do that. Now there's other things to think about that people tell you, oh, I got this good rate, but they don't tell you, what they're actually doing, and you don't know the little nitty gritty of it. You've got rates that are for basic residential. You've got rates for second property, meaning like I've got a cottage or something like that. You've got a different rate for a rental property that is higher than your owner occupied property. So there's multiple things that happens down there, and they all attract a different rule. So just coming and say, hey, I got this, how come you didn't get that? Yeah, it's kind of unfair.
Yeah, yeah. So, I think the takeaway from that question or that point is you have to do a consultation. Consultation is going to be tailored for you and your family and your working industry, specifically to you. I am a real estate agent, and there are lots of other real estate agents, but we may not have the same mortgage rate, although we're buying at the same time, right? So it's got to do very specific for you. Think of it as a doctor's consultation, right? For when you're going. So it's very specific to you for your health. So this is your health for your mortgage, right? It's very, very specific and tailored to you, your family, your credit history, your work industry, and especially in the pandemic now. So you want to make sure you get that consultation done and by a professional, not and you also would listen to your aunt and your uncle and all of that, but that's to listen and acknowledge, I hear you, but this is my consultation specifically for me. So that's one of the things. One thing I want to touch on before we close off, how are we seeing, so right now, one of the things that I do is sort of build investment portfolios for my clients. So look at building more than one properties under their portfolio, right? And that takes proper planning. And proper planning, I mean, sometimes we say we're an investor. Hey, I'm an investor. I've got 1, 2 property. You're not really an investor. You just happen to accumulate 2, 3 properties over the year. To become an investor, you've got to have strategic planning, know what your return on investment is going to be in X number of year, and have a plan on how many assets that you're going to add over that year. And that's when you are an investor. Adding 3 properties over 10 years, you're not an investor. Don't mean to sound cocky, but that's the reality. When we're looking at an investor portfolio, we have seen some things that change in the industry. And I want to ask Danny this question. I'm seeing now that some of the lenders, I think, are asking for a little bit more down payment. So we know if you're buying an investment home, it used to be the norm where you're putting 20% down. And usually the math is worked out a little bit differently. Now, lenders are asking for a little bit more down. We're seeing the interest rate, although interest rate is very low on your personal resident, right? Primary resident. When you're an investor, your interest rate go up a little bit more, right? So you're going to tell me how that is. I'm just going to tell you what I'm seeing or what I'm hearing for some of my investment clients, right? And there are, tighter regulations on investment properties for investors in sort of the underwriting, like basement finish, is it legal, things like that.
Again, a big story there, but let's try to address it. In essence, lenders have to lend, but there's the risk involved. Okay, you're taking a risk as an investor, but the lender is taking a risk because they're lending money, and it's at the end of the day, you go to a big bank, you go to wherever, the money's coming from somewhere. So there is an accountability aspect to any deal. So they have to be accountable for that money that they've invested, and they get the right return in terms of their investors getting their reward for investing that money. Because, I mean, face it, we're all here to put food on the table for our families, right? So the investor in the back end who's financing your mortgage is no different. And I'm not talking about the big sign that you see above the door that you go in. I'm talking about people behind the sign, that invest in those mortgages. So you got to bear in mind that they have a risk that they have to look at. And like everything else, the bigger the risk, the bigger the reward. The smaller the risk, the smaller the reward. Think of yourself, got $1,000 to invest. You go buy a GIC, you get pittance. But you invested in some kind of high risk mutual fund, your return could be big, but you can also lose your shirt on
Yeah.
it as well. So you got to think about it from that aspect of it. So they are taking a risk when you're taking on multiple loads of debt. So your risk is now higher. So they're taking, is my owner occupied? Yeah, I'm going to do whatever it takes to pay for it because I got to put a roof over my family. But now I'm buying 2, I'm buying 3, I'm buying 4. I've got all these things that I have to do. So now you're putting yourself out there and you're taking a lot of risks. So these guys are taking risk, lending you money now. So hence the
You
interest
want
rates
a
are
little bit
higher,
more, you want
right?
to top
So
up on
yeah, they're taking a bigger risk, so they want a bigger reward on it as well. So you got to be mindful of that as well from the lender perspective, right?
Yeah.
So you look like you want to say something. Go ahead.
Yeah. So yeah, I just wanted to say for investors or, younger investors, mean younger in terms of experience in the trying to get into the investor field of properties with intention. you kind of have to give a little bit more in terms of mortgage now to get that. So lenders are asking for a little bit more down payment. Just
Yes, they
beware of
are.
that. We
Yes.
want to make it clear that that's how it is now, and because lenders are taking you've got multiple now under your portfolio, and they're asking for a little bit more down payment, and we want to make sure and also we want to do our math where the interest rate is a little bit higher for investors. Right now we're doing business, we're becoming an investor, we're not in our primary residence. So
Let me
guys out
follow up on
there,
that, Mary. Let
huh?
me follow up on that.
Yeah.
When you look at, you're looking at the bigger down payment, people are going like, why? I'm going to pay it. I've got good credit. I've got R1 across the board. I've always paid my bills. Why wouldn't I pay it? But you got to look at priorities in life, right? I mean, it's unfortunate, but it happens every day. Somebody loses their job, income, all of a sudden that income stream that you were depending on to pay your bills is no longer there. So you got to look at it like if I've got, something that I'm buying for $100. Again, I'm doing wrong numbers, small numbers that we can understand clearly. And I put a $5 down on it. And, I've got other things around the place. And now I'm in a place where I got to walk away from something because I can't carry all these debt loads, right? I can't sell it. One of them has to go belly up. Which one am I going to choose? The investor, is going to choose the one. I'm not saying this is going to happen. I'm just doing hypothetical here. I'm going to choose the one which is where I'm going to lose the least amount. So I'm going to walk away from the one that I only got 5% on, $5 in. But if I've got something that I've got, $40 in, I'm going to try to keep that because I'm going to try to save my $40. I'm going to walk away from the $5, but I'm not going to walk away from the $40,
Yeah.
right? The 40%. So you got to look at it from all these angles when you're dealing with a lender as well. Okay, so but there are lenders out there that are doing that. And when you're talking about investment, obviously, if you're going to have multiple properties, you're going to have tenants and all this kind of stuff. We touched on paying a higher interest rate if you've got a property that is rental. You're not going to pay the same low rate that you're paying with the one you're living in. You're going to pay a higher rate. But there's also other things on there that as an investor, it's kind of like a domino effect, a cascading effect, because once you start renting out now, that money that's coming in from the rent, that's now income. So your income goes from here to here. So you declare that income to Canada Revenue Agency, obviously, and that now becomes income. And the lenders out there, I mean, I got it up yesterday, actually, I got one of the lenders send out promotion that they're accepting 80% of rental income um, towards qualifying. So basically, what they're saying is if you're gonna get $2,000 a month in rental declared income, right? Then I can use $1,600 of that to add on to your income. So I'm gonna do 16 by 12, right? And that adds on to your annual income. So all of a sudden, when you were buying the property, your first property, your income was this in terms of qualifying, and now you're buying the other property that you already in one rental, you now have extra income. Yeah, you have extra debt, but you also have extra income. So it one builds on the other, and you keep going up like that, and you just expand your portfolio, and all of a sudden, as you rightly say, you're not your one-two property, you're now an investor.
You're now an investor, and so you want to be able to think like that, and
Yeah.
as you're looking at it from a business perspective, you've got to understand that the rates are going to be different. Yes, you're
Mm.
going to be making a profit, you're in it to make a profit, so you've got to understand that you have to give a little as well. So again, being an investor is a great thing here in Ontario. You're putting in, let's say, 25%, and you're partnering with a bank to fund 75% of that deal. I mean, it couldn't get better than that. So you're blessed to be an investor here if you work your numbers really well. And it's one of the, especially where we live, and in real estate is going up so fast, to get into that market as an investor if you can.
Let me give me 60 to 90 seconds here.
Sure.
Let me start with something that you have to think about once you start to get into that investor realm. ROI. Okay, so you got to think about ROI, your return on investment. Okay, in 60 to 90 seconds, I'll give you a scenario that I was involved in about 9 to 10 years ago. 10 apart 10 apartments in a building, small building, small apartments. The apartments were so small that the bed, you couldn't get bigger than a double bed. If you put a queen bed, you can't walk around it. Apartments were renting on average of $700 a month. 10 apartments above ground, no basement. Older building, built in 1913 or something, a previous school or something like that. Income on it, like I said, $700 a month approximately for the apartment. The building, the people that were doing it, we couldn't get a traditional mortgage for them. Some of them were overseas based as well. So what we did was they had two. The building was $880,000, 220,000 down. So what was done in this scenario was a private lender. Now, don't fall off your chair. 8%. eight
Yeah.
percent interest only. 8%, 8% interest only. If I remember correctly, the payments per month was around 3,500, something like that, a month. Interest only. So borrowed $660,000, never touching that principal. 3,500 approximately, or a little bit more. Okay, a month. Okay, that was $42,000 a year in interest going to that private lender,
Mhm.
8%, right? The building, I'm going like, holy smokes, what am I making here, right? ROI. Let's do the math backwards. Property tax on the building was $11,000. So 42 in mortgage, 11,000 on property tax. You're 53,000 and a few knickknacks around the place. But income on the building, $700 apartment, fully occupied, long-term tenants that some of them were there like 25, 30 years, older people, not planning to go anywhere. Okay, 10 apartments, $7,000 a month. Okay, 12 sevens is $84,000. Okay, $84,000 in income, 53,000 we already figured out property tax and mortgage, and let's say Nix and Nax takes you up to $60,000 a year. Okay, 84,000 is income. So you had 24,000 in terms of cash flow still left at the end of the year. That property stayed in that scenario for 3.5 years, sold for 1.1 million. Okay, the private mortgage guy got his 660,000 in addition to 42,000 a year for 3.5 years. So he was laughing all the way to the bank. He loved it. Okay, paid him back his $660,000. The property sold from 880 to 1.1 million. Do the math, 24,000 a year cash flow in the plus for 3.5 years. Do the math, right? So when you talk about interest rates and people are going, well, I'm getting 1.99 for my house, and my rental property, I got to pay 2.5% or I got to pay 3%. Seriously, it's all math. It's ROI. It's your return on investment. You got to look
Exactly.
at it from a business perspective.
So you
It's
see,
a
I
business.
call it. So I might be taking on a limb here. So I call it greedy investors as well. And it's not to label, but we call it greed. It's like you're making money even at 8%. So 8%, and you're just doing interest
Interest only.
only. And this is a collateral mortgage, right? They have an
It is
asset there. 84,000. You're still making over that 3 year over 200,000, right?
easy.
Right? But when
Easy.
you're coming from a perspective of greed, then trust me, you're going to have an apple here and you're not going to eat it. You're not going to be able to get a bite from it. And that's where you bottleneck yourself when you're being greedy. You want to use someone else's money and you want to be greedy with it. You're not gonna make anything. So when you look at it as an investor, you got to spend a little bit money to make a little bit money, right?
Yeah.
For example, and we're going to close off. We know we said it's going to be short, but it's over an hour. For example, I'm a realtor here in GTA. I've got an office location in Brampton, but I'm for my makeshift home office right now. I invest in a lot of tools. I invest in a lot of tools and not just putting up the listing on MLS or just, your Microsoft Word, Excel. No, I invest in a lot of tools for my clients and for myself to make my job easy, to make my clients' job easy as well in acquiring or acquisitioning the home. Investing time, like talking to Danny, talking to other business partners to make my clients' goal achievable. Now, I've got to spend some money to make some money. And that's the reality of it. You want to invest in a property, you've got to be able to spend some money. It's not going to happen to be free. If you're free, we'll let those clients go. You're not in the business of making money. You're in the business of where you just want to get something without investing anything really. So even at 8%, you're still making 200 and something thousand. So
Close
look
to
at what
300.
you got. Don't look at what that private lender made. Look at what did I get as my return on investment. Be grateful, be blessed that you've got that as your return on investment. Never look at what the other person is making. That's for his family, that is for his business. Look at what I am getting. What am I getting on my ROI? Right? Investors as well are people like you and me with emotions, right? With these five types of emotions. So even as an investor, we are doing our consultation and risk analysis based on these four emotions that we have. So for investors, you got to spend a little bit to make some money. And as long as you're ready to do that, we've got Danny who can do a consultation with you and can tell you all about what options are available for you mortgage wise. He's got over 140 something lenders available for access depending on what industry, so you'll be covered there. It's got over a decade in the mortgage industry and just over half a decade in the current brokerage that he's with, and 2 decades in teaching at Humber College. So you've got
Sheridan, sorry.
at Sheridan
Sheridan.
College. So you've got someone who is educated, who looks at the family first when you're doing a consultation. So it's my pleasure, Danny, to have you here. I want to thank you for taking the time out of your day today to discuss some things on mortgages. And for anyone who wants a consultation, drop it in a comment section, or if you don't want to drop it in a comment section, just send a direct message. Danny's number is on the screen. And so it's on the screen there, or you can reach out to me directly and I'll just connect you, or you can do a direct message on Facebook and we'll connect you together. Danny?
First of all, thank you for having me this morning. It was a pleasure to participate with you. One of the things I like is you've not only experienced in the real estate, you've got the knowledge on the finance side of it as well. So it makes the conversation flow a lot better. So you understand exactly where we're coming from, and an excellent job in summarizing everything as we're going along to break it down, for all the viewers out there. What I would like to leave with you today is, we as professionals, and when I say we, I'm talking meaning myself here, that you're looking at today. It's not. You buy a house and then you don't see us again. And I think I am going to be a little bit presumptuous here, and I'm going to speak for both of us. When we work with you, you're going to be seeing a lot of us up to when you get that key. But that doesn't mean that's the end of our relationship. Our relationship goes on because somewhere along the line, Minnie's going to be checking in with you. How are you doing this? How are you doing that? How's the kids in school? Is everything working out? Are they going from, middle school to high school, or kindergarten to middle school? Is there enough schools in your neighborhood? Are you guys looking, maybe you need to move up, something like that? She's going to be talking to you. I'm going to be talking to you all along as well, like, how your finances, you guys are good, you got some equity in there, you got a kid coming up for university, are you prepared for that? You're a new immigrant, do you want us to do a little refinance, take some equity so you can take care of that? This relationship, what I'm trying to get at, is a lifelong relationship. As long as I'm working, as long as Minnie's working, we are with you on that journey forever. And the reason I like to emphasize this is because I see a lot of people, we call them like one hit wonders. They show up, they do a deal, and most of the time, these are the guys that do the trashiest deals out there, and then you don't see or hear from them again, and they're gone. Whether on both sides of the industry that we're both representing here today. So, you know what? We're here to build relationships. We're here to work with you from here on forward. And as long as we're there. Now, if I'm retired, doesn't mean you can't ask me a question. I might not be able to do something for you, but I can definitely advise you and point you in that direction, speaking for myself. So, you know what? It's been a pleasure this morning, spending time with you, our viewers out there. And hopefully what we've done today does, help you in some which way informed towards that home of dream ownership. Whether it's investment property, your first home, whatever the case might be. Now, we haven't done everything here. I think I'm going to propose, Minnie, we got to do this again. We haven't even touched on pre-approvals.
Yeah,
The
and
whole the
privileges.
whole the whole bidding war thing that's going on now. The shortages of properties on the market, like which neighborhoods you can get better bang for your value,
Yep.
for your money, all that kind of stuff. I'm sure Minnie's got a million things, and on the finance side, we haven't talked about conventional. We haven't talked about insured mortgages. I'm sure you guys heard of CMHC, Canada Guarantee. all these people that insure high ratio mortgages, all this kind of stuff, we haven't even touched on. So this is really a 1 hour that went by pretty quick, and usually that happens when you're having fun. And I think we did have, we do enjoy. I can see the smile on her face. We both enjoy what we do, and when you enjoy what you do, it's not a job anymore.
No,
It's
it's
a job. If you can't smile and that hour goes by like that, if you're like talking and you look at your watch and go, holy smokes, we only done 10 minutes and we planned for a half an hour, then you're in the wrong job. You're in
yeah.
the wrong job. So I think we've addressed a few things today, and maybe at some point in the future we'll address a few more things. My number is there. Feel free to reach out to me or to Minnie if you have a question, a comment, anything. If you feel there's some things that you want addressed, you got questions on, we should do something else, whatever the case might be. It's been a pleasure. Thank you so much for having me, Minnie, and thank you guys for looking at us today.
Yes, and so before I go, I know one of the things is every month I'll be bringing on once a month so far, one person to interview. And if we're going to do a follow-up on, and there's a particular topic that you want to address, maybe, and no question is a silly question. However, you can present that question to me. Even if it's not the right terminology, that's okay. We get the gist of it. We'll answer that question for you, and we can build a topic around it. So we're people just like you on the other side of the screen. And so you can reach out to us. You can send me a direct message, and you can give me a call or a text message, and I'll be more than happy to have a session around that particular question that you may want to address. Please go ahead and share this video on any platform that you would like. You've got my permission. You don't need my permission. If you know anyone that's looking to buy a home or invest a home in the Greater Toronto area, and in some cases outside, I do investments for my clients outside of Ontario as well, please do not hesitate to share this video. Drop a comment in the comment section below. One of my goals this year is to up my social media reach, and how you can help me do that is by commenting. When you're looking at it, I know you're looking at it, but what the algorithm like is that participation. So if you're here, drop a thumbs up or a comment or a smiley face in the comment section below. I do appreciate it. Talk to you soon again. It's Minnie here from Brampton, Ontario. And Danny, thanks again for taking the time to join me today.
Thank you.
You're welcome. Bye-bye.